We have many banks in the US economy. The major five banks are Bang, number one, the stock market tsunami, why the bubble is about to burst, and what to sell right now. The US stock market is poised for a massive crash, and experts are sounding the alarm. For years, stocks have been skyrocketing, with prices far outpacing the profits companies are actually making. One major indicator of this bubble is the price to earnings, or PE ratio, which is at levels only seen twice before the 1929 stock market crash and during the dot-com bubble in 2000. Both of these periods led to massive market corrections, and the current situation is eerily similar. But there's more to the story. The US government is borrowing a staggering $1 trillion every 100 days, and Wall Street has hit a breaking point. In October 2023, for the first time, Wall Street told Washington it couldn't absorb any more government bonds, signaling a serious strain on the financial system. This bond market saturation puts additional pressure on the stock market, as investors are forced to reassess their portfolios. The upcoming crash could see the stock market plummet by 50% or more, and smart investors need to act fast to protect themselves. What to sell immediately? Certain types of stocks are especially vulnerable to getting crushed in this kind of market collapse. Here are the ones to watch out for and sell from your portfolio immediately. Number one, high PE growth stocks. These are companies with sky-high stock prices relative to their earnings, often in the tech sector. While they may have shown great returns in a booming market, their lofty valuations make them highly susceptible to sharp declines. When investor confidence drops, these stocks are often the first to tumble. Number two, highly leveraged companies. Firms that have taken on significant debt are at extreme risk in a downturn. As borrowing costs rise due to increasing interest rates, their ability to manage debt becomes strained, leading to potential defaults or sharp declines in their stock prices. Number three, speculative and unprofitable startups. Startups that have not yet turned a profit and are reliant on future growth are particularly at risk. When the market corrects, investors flee from these speculative plays, and these stocks can lose the majority of their value overnight. Number four, cyclical stocks. These are companies whose fortunes are tied to the broader economy, such as those in the automotive, construction, and luxury goods sectors. When the economy enters a recession, demand for these products plummets, and their stock prices follow. Number five, small cap stocks. Smaller companies tend to be more volatile and have less access to capital. In a market crash, they can be hit disproportionately hard as investors seek safety in larger, more stable companies. Action steps. If you hold any of these types of stocks in your portfolio, now is the time to consider selling. As the market correction looms, repositioning into safer assets could be crucial to protecting your wealth. Look towards safer dividend-paying stocks, or consider federal money market funds that offer stability in turbulent times. By acting swiftly and reducing exposure to these vulnerable stocks, investors can minimize their losses and be prepared to buy high-quality stocks at a discount when the dust settles. Follow me for the rest of banks and how to avoid them.